Hi guys, welcome to the second Trading Club meeting of the year already. It's already February. January has been an incredible month, so much action, mainly to the downside. This is Lex van Dam together with James Helliwell, Head of Markets at the Academy. We have quite a few slides to go through, so let's get started. I want to make sure that you realize that markets obviously move around a lot. And the price we see on the screen is not necessarily the real value, the true value. Obviously, it's the price where you can buy it now. But when you are in periods of distress, as we've seen this month, then sometimes that represents amazing opportunities. So what Benjamin Graham said, famous quote: "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." And what it means is, in the long run, it's going to be about finding real value, finding out what the real value is of a stock or a currency. But in the short term, it doesn't really matter if something is an amazing opportunity long term. If people are selling, then it's going down. So the market is a voting machine, and long term a weighing machine. So we've seen the worst start of trading since 1920, so the worst start in about 100 years. Obviously, none of us were around in 1920, not even our older trading club members.
Just Soros.
maybe Soros.
Soros.
I don't think Soros was around either. And, so obviously, maybe you want to explain the chart you see here, James.
Yeah, we tried to sum up the month in a chart, and then I had to use another chart after this as well. But basically, you can see the volatility index for equity volatility. January, 27% increase on the beginning of the month, pretty much captures what has gone on across markets. Risk has increased across all major asset classes, and it's represented by the spike we're seeing in VIX, in the volatility index, which remains elevated. If we were to sum it up in two charts, I couldn't quite get rid of the first one. The last time when we presented last month, we produced a club meeting on New Year's Eve, I believe. It's the end of the month. Janet Yellen had come out on the 16th of December when the first hike was announced, and suggested that by the end of 2016, her rate guidance on behalf of the Fed was that we would be at level of interest rates of 1.375% in the US, equivalent of 4 hikes by the end of the year. At that time, the market had only priced a 10% probability of that actually occurring. As you can see, it's the market-derived price for futures. So you can see that on the left-hand side, and that in the last month, so from the 29th of December to the 27th of January, at the time of producing this, has dropped to below 1%. So they've lost all faith. The market has lost all faith in the Fed actually achieving that target. Not to say that it won't hike in the meantime, but her guidance is off, according to the market.
Okay.
So that's what's dictated trading over the last month. The reason why we've seen risk off and liquidity ultimately being withdrawn from various asset classes. And we go through some of the reasons here, which is what will form the basis of the meeting this month. And Lex, do you want to say?
Yeah, I think James and I were talking about what are the important highlights of this month to discuss in further detail, because there's about 40 to 50 different things that I found really, really quite striking. So we can't talk about everything, but the themes that we'd like to talk about today is oil. Obviously, oil has totally collapsed. What does it mean? What are the trading opportunities that are represented by the oil price at a much lower level? Second thing to talk about is China. A lot of capital outflow we've seen. The currency is under pressure. Again, what's going on there? How can you trade it? Third theme that I want to look at a little bit is emerging market debt. We saw in Poland that with the new government that they say, well, actually, we owe foreigners a lot of euros, but it's a lot easier for us to just print zlotys, so why don't we pay these people back in zlotys? And that would have obviously serious consequences, not just for Poland, but a lot of the other emerging market debt. So that's an interesting theme. Then the fourth one, sovereign wealth fund liquidation. It's pretty related to oil. A lot of low oil price is clearly not good for countries such as Saudi Arabia, for Russia, and some of the subsidies in these countries are at the same time being pulled. You have a group of people there that need to be supported by the government, and the government can't do it anymore. And with this oil price, low oil price, instead of being buyers of securities, a lot of these guys are now actually liquidating. So that's very interesting. Then we look at the US IPO market. A lot of companies over the last couple of years didn't go to the market because it was very easy to raise money outside the market. Well, this so-called pre-IPO market has come off a lot, and at the same time, the IPO market is also cratering. And then further, we've seen technical breakdowns around the world. We're going to look at some charts, and we're also going to look at share buybacks and how they're coming down massively because the cost of credit is going up, and again another support to the market is being taken away. So there's actually quite a lot of negative themes developing. However, it doesn't necessarily mean that long-term value is no longer there, and the market as a voting machine means that it's maybe this is time to buy some, or maybe it's not. So that's what we're going to be talking about.
Cool. So that sets a tone for the meeting ahead. So let's crack on with the first topic. It's in no particular order, but we thought we would begin with sovereign wealth fund liquidation, Lex. So on this slide that I pulled together, it's from a Preqin report, so third-party source. But what we attempt to highlight here, and these numbers will vary according to who the source is, but according to Preqin, you can see here around 51%, so over half. The world's, of the top 15 sovereign wealth funds, the largest ones, more than half of these assets are derived or linked to the price of oil. So with that coming off, it demonstrates that a lot of the largest sovereign wealth funds, largest institutional holders often of stock and so on, many other asset classes, bonds also, are feeling the pressure and are having to raise money to fit their funding requirements, which have dropped with the price of oil, and are maybe turning into sellers, or we have seen selling, maybe turning into net sellers in some cases.
Yeah, and it's going to be interesting to look at Norway, which is the richest of them all, ahead of the UAE. If you look at China, if you add it all up, then actually it is bigger than Norway. But if you compare Norway to the Middle Eastern countries, with much less demographic pressure, so they have a lot of money, but they they don't need to spend it all. While a lot of the other countries do need the money. So does it mean anything for the Norwegian kroner versus other currencies? So that's the kind of stuff you look at. But it's here, it's really amazing that 51% of these assets are from oil, and oil is totally collapsing.
So just quickly behind those numbers, you've got about $5.25 trillion worth of assets here, of which 2.7 trillion are derived from oil. So that's the 51% number roughly, and that is the equivalent to around 10% of the total market capitalization of all listed companies, not the S&P, but all listed stocks. Okay. So it's a significant chunk. Of course, they invest in global markets, but as we'll see with the holdings on the next slide, which correctly anticipated, you can see a lot of the names. This is, for example, the Swiss National Bank, which isn't as heavily reliant on oil specifically, but as a gauge of that, you can see also this is from I should point out, the September filing, so it is going back a quarter or so on Bloomberg. You can see the top 10 holdings are all large US names, pretty much the Dow constituents with Facebook in there.
So they've got $1 billion. They've got $1 billion in Apple. Total value of the portfolio on the top on the right was 40 billion, 39 billion on the 30th of September last year. It's now going to be quite a bit less. Apple has obviously dropped quite a bit this month as well. So $1 billion in Apple. I mean, I'm not quite sure whether the Swiss National Bank should be owning Apple.
Long cash
but they are. And you can be for sure that if the Swiss need money, then they think, actually, you know what, let's sell our Apple.
Yeah. Maybe, do you think it's maybe a dollar trade? Or it's probably not.
It started off obviously for the Swiss franc. There was a lot of demand for Swiss francs, and then they let it go. So there's a little bit less. So it's just was based on their currency, defending their currency. It's investing their inflows.
Yeah. Okay, so to the charts, the exciting stuff. Lex, you mentioned buybacks at the beginning. Buybacks. I've got here, tongue-in-cheek one. This is the relative performance of the. It's an ETF which tracks the largest S&P 500 companies buying back their stock. We've looked at this in previous months, but but it shows the relative performance compared to the S&P 500. What we can see here is a major technical breakdown, and it's basically come off the highs which peaked towards the middle of last year, just before actually around April time. It's in a downtrend and it's breaking major support now, and also a major trend line. So it looks as though with the prospect of higher interest rates and perhaps slower growth and higher borrowing costs as well, it looks as though it's going to become increasingly difficult for companies to access capital to fund these buybacks in a higher interest rate environment or a slower growth environment.
So there's a basket of companies that buy back their own stock.
Yeah.
And what normally happens is they raise money, they can finance debt at a really cheap level, and then they keep buying back the stock, so the stock price goes up, so that they're changing their capital structure. And that's worked very well for a long time as rates were going lower and lower.
Making the earnings look better on a per share basis, to reduce the number of shares.
But now, you know what, it's for some reason it's no longer working. Even though rates, as you can see, but you can't see, but rates haven't. We'll talk a little bit later about it. Rates have they're back at the lower levels, courtesy of nobody believing Janet Yellen, as we saw before. So here we see at the top level, you see it in absolute price. So that's coming off, and relatively it's even as we saw before, performing even worse.
Struggling to break that average. I know 200-day moving average.
And to me, it's like you can look at this chart. There's some chart breaking down, and you can say, okay, relatively to the S&P, maybe you should be buying it, selling it, whatever. But the real interpretation of this chart is actually, you know what, like a big support of the markets, i.e., companies buying back their own shares, is no longer working. So these companies, seem to be wanting to do something else with that money. Maybe they actually really need it.
And big companies as well, such as Apple, have been hurt by a stronger dollar.
Of course,
as well as that in terms of sales, or currency exposure. So we ran a screen here which essentially looked for. You can see on the right-hand side before we go through the names. This was taken from the Wall Street Journal last year. We featured it on in one of the meetings. It showed some of the, in terms of value, largest repurchasers. Not surprisingly, it's largest companies, typically in America. On the right-hand side, that was to date during 2015. It's probably a Q3, Q4 impression. But what we did to get some new names there, current names, was run a screen for the largest companies in the S&P 500 that were buying back their stock. In fact, we looked at the S&P 100. It is the S&P index, it's top 100, right?
Yeah,
S&P 100. Then for companies that have been buying back the shares, large repurchase programs, but also had sales growth which was slowing, not necessarily negative, but was slowing. And then to boot also sorted that by companies which have been selling their stock recently.
So insider selling stock.
Yeah, directors, management, and so on. Quite right. So maybe a lot of confidence there. So with that trifecta, as it were, here were the 10 names that you can see on the screen on the left-hand side. A couple of those stand out and will be mentioned later. Union Pacific is one that I'm keeping a close eye on. You can see some of the technology companies in there. It's mixed themes within this, but they all share that in common. So how has this style performed recently?